Three, two, and one. Hello and welcome to another Capital Gains Tax Solutions Mastermind. Reaching every week, we are trying to bring in some of the best resources, thoughts, strategy as it pertains to wealth building, tax deferral, exit planning. For those that don't know me, my name is Brett Swartz. I'm founder of Capital Gains Tax Solutions, and I have the privilege of spending some time with some amazing individuals this week. And I want to share some insights as what's going to kick us off today, which is insights from the number one ultra wealthy investor club. It's called the Family Office Club. And this was in Fort Lauderdale, Florida. And it was really neat to be able to spend some time with about 1,000, maybe to 1,500. I don't quite sure the number of some of the most wealthy, strategic, impact focused individuals that are creating businesses, developing real estate, creating companies, and really trying to change the world with health, with wealth. And so some insights I want to just share with everybody today, and then we'll dive into the deferred sales trust and how it kind of this fits in. By the way, I want to shout out for Richard C. Wilson, who's the head of Family Office Club. In fact, you can learn more about them by going to familyoffices.com. And for those who are curious what a family office is, it's essentially sort of like ultra high net worth individuals or families creating a ecosystem to manage and build their wealth. And Family Office Club is a conglomerate of those individuals. And so this was established in 2007, and it has over 4,000 investors and, that are mixed between family offices and investors and such. So Richard did a couple talks, and part of the talks that was so interesting, he talked about focusing on de-risking the average. And one way that he does that is the concept of focusing on studying what the best do. He used the analogy of you could study what like a Duke basketball player does, let's say, for example, or you could study Michael Jordan. And sometimes the person who writes the book, or sometimes the person that is doing the thing, they might be good at what they do, but what are the best doing? And so the concept of that, what would the Michael Jordan say about, playing basketball versus just someone who's really good at it? And so about de-risking the average is about going to the very top. And the way that he does that is he studies billionaires. In fact, he also has a company or a website that's turning into a company called billionaires.com, where he brings on top billionaires like a Tony Robbins to discuss in a 10-minute talk, 3 questions to help people, build wealth and build legacy. And so he also de-risks the average by actually reading books from billionaires, not just about billionaires, but from those who actually are the billionaires. And so one of the books on the list, which I'm reading right now, which I love, I'm almost finished, is Am I Being Too Subtle? And this is a book that is a phenomenal book by Sam Zell. And Sam Zell is an icon when it comes to real estate, investing in business and timing. He is phenomenal when it came to building massive amount of wealth and starting from the very bottom and working his way up. And so this is the concept that for Richard, he talked about reading 250 books or plus books that are on billionaires. He has a whole list, and his goal is to read and spend about an hour a day, either an Audible or reading, 1 hour a day on a book by a billionaire until he's finished all of those books. Is he going to read any other books? And that's the concept of de-risking the average versus spending the majority of the time reading books from those who are not the billionaires. So I thought that was really interesting. And it's something that I'm planning on embracing in 2024 is de-risking the average. The next thing had to do with explaining how billionaires succeed by creating projects and then hiring excellent managers. And this is something actually I'm practicing right now with Capital Gains Tax Solutions. We built the company now over the last 5 years, but really the last 3 really intentionally. And now we're scaling it and finding a way to have excellent managers run the company to be able to scale. Like Tony Robbins, for example, I think he has, at least 100 or 150 plus companies, maybe more, and many of which are billion-dollar companies. And he would never have done that had he stayed in one single company or just a couple and not hired great, amazing team members to scale that and be able to walk away from the day-to-day involvement so much so, right? Where he can hire the team, hire the who, not be the how. And so the concept is simply that you get the momentum going, you have the idea, you have the vision, you build it, but then you pass that on to the next manager, and you go launch the next company or the next business, the next deal. And so that, I think, was made a whole lot of sense. I'd look at the concept of if you're going to scale multifamily properties and how one might do that, and that would be the same concept that you buy 100 units, 200 units. You could manage that and manage the projects and the value add and be a part of that, and maybe, save some money there, right? Or you could hire out great managers and go buy another 200 unit property, another 200 unit, and keep doing that, replicating those systems to hire great folks, and then to continue to scale. Same concept when it comes to business. And I thought that was insightful. The next thought he talked about was the law of proximity. And he discussed on focusing on energy on what works and discarding the things that don't. And actually, the law of other part of proximity is the proximity of, for example, being in a room with the family office club where you have thousands of investors, and then, maybe probably 50 family offices, plus, billionaires speaking on stage and people who run billion-dollar companies. The law of proximity just helps you to level up as you're in these rooms, as you're absorbing, as you're seeing how other people think and approach solving different problems. And I think that's the key, asking the right question to get a better answer to solve the problem. And that law of proximity, the closer you are to those that are successful or those who are ahead of you, the more that, and essentially you can be like the average of the 5 people that you spend the most time with. I think the same is true when it comes to masterminds, comes to coaching, comes to being in rooms like the family office club. So that was really cool. I really enjoyed that part of it. The next part was applying, focusing on energy on what doesn't work and discarding what doesn't. So he talked about listing out the biggest things that take away your time, your energy, and perhaps even your joy when it comes to, your work that you're doing. And the late Charlie Munger passed away. I don't know if you saw that. He was partners with Warren Buffett, and he had a couple principles that he stuck to live by, and talked about cutting out toxins and anchors. And there were 6 of them. And number 1 was energy vampires. So what are the energy vampires that are pulling your energy, sucking the life out of you, killing the momentum? Quote that we practice here at Capital Gains Tax Solutions and remind ourselves is that momentum is more powerful than all of your leadership, resources, and strategy combined. And that comes from the amazing Greg Kroschel, who has one of the top leadership podcasts. If you haven't subscribed to that, you should. It's fantastic. I listen to it at least once a month because he released an episode once a month. But I just continue to absorb that. And so, what are the things that are pulling away from your energy, but also pulling away from your momentum, right? And really making sure you're understanding, you're writing those things down so that you can remove those things. You can cut them out. Number 2 is bad deals. Like, what are the bad deals that you're in, or that you could be in, that you shouldn't be getting into, that could also stagnate that momentum. So you want to make sure that you are doing everything you can to cut out those anchors that are holding you back, with energy vampires, bad deals. The third one was, he said, mediocre employees, right? So if you don't have a rock star players, those mediocre team members are going to pull you back, and you don't want mediocre employees or team members. Number 4, the top couple of most time-consuming clients or stressful clients. So are those certain clients that you work with that you've committed to, but the relationship or the time and the energy you're spending on them is now it's pulling you back again. It's cutting that it's stagnating the momentum. The next one would be the employee who produces great results but hurts your company culture. So they could be A+ with productivity, right? But they could be, a C or a D when it comes to company culture and morale. And so you want to make sure that you're balancing productivity with company morale as well as culture, because culture always beats the rock star A player. The team is always stronger than the individual. So make sure that you're balancing and understanding that. And number 6 was negative friends, news, inputs into your life, brain, or business. And so this is for me. I've turned off the news for the most part over the years as things have become, politically even more intense in our country. But I also, part of that was I had to turn off the negativity that can come, and it can, again, pull away from the momentum. for the purpose, for the mission that I'm on, my family's on, our team is on. And so these are just 6 things that Charlie Munger recommends, and also Richard C. Wilson, which I thought was great. And then I'll finish with this point. One of the things I learned from Richard was every year, one of his goals, and I want to adopt this, is to make that next year the most fun year of your life. The most fun year of life. I think so often we're focused on making each year the most productive or the most profitable or the most, something, right? And it's focused more on the monetary than it is on the fulfillment factor. And so I think the fulfillment is much more important, because we just don't know how short our time is. And that, for us, practically what we're doing is trying to spend 1,000 days, extraordinary days, in 100 unique locations with our children, my wife and I, Melanie, before they're 18. And so we have a specific goal to have extraordinary days before they're 18 in 100 unique locations. And so our mindset is centered around, and our calendar is centered around the family extraordinary events. And sometimes that means being creative with work. Like, we were just down in Fort Lauderdale, Southern Florida, and I brought the whole family, and they were able to go to the zoo I was working, go to the, spend time in an amazing, cool Airbnb with this, really cool pool, and sitting on the water, and just these extraordinary events. Now, ideally, I'm with them doing those things, and we typically, have a before and after the trip. But finding ways to do that. I also recently shot a video with Kevin Harrington from Shark Tank a couple of weeks ago, and I brought 2 of my daughters to experience that. And we hung out at the hotel, had a nice dinner, and on the 3rd, 4th story on top of a pool deck overlooking when they're having a concert. And it was just these cool events and these memories that you can create if you're just a little bit more intentional about it, really focusing on making the year the most fun year of your life. A couple other notes he put down here is he personally quit 2 boards. He's on these advisory boards, and he talked about how he's sitting on these Zoom calls every quarter with he has too many boards that he's on. And he's just going, this is a lot of time and energy and pulling from my momentum of what I'm doing day to day. And he said he felt like he was spending just a little bit too much time building someone else's business, with these boards that are kind of piling up, sitting on Zoom rooms, which can be a little bit exhausting at times. So he's turning down, he quit 2 boards, and he turned down money for time equation, focus on medical and dental practices. And so also focusing kind of more on the niche of where he's building wealth, canceling all meetings he doesn't want to take or do. So instead of having a meeting where you're halfway in, or you're not really sure that you want to be there, he doesn't want to take it, he just cancels it. He's only spending time on exciting, exceptional projects. So being very diligent and being a good steward with his time and his energy. And then he talked about firing stress from his team. So finding out how the team is being stressed, and then firing, let's say, an employee or something that's causing that stress, and also his client list, and putting energy into what's working. Oftentimes I think that the negative, we tend to focus on that, and we put our energy into the negative, or the squeaky oil, right? But the squeaky wheel that needs the oil. But that can be the negative, and that can be small impact, right? But because it's making a lot of noise, it tends to get a lot of our energy. And so he talks about just cutting it out and firing that and being done with that, so that you can focus on the things that are working, that have a bigger impact. And I think that was really a really insightful and a good reminder. And the last one he talked about was just, he called it just do it. It's like the Nike thing, right? Just do the thing, just grow, just expand, just acquire, just level up your health. Just, the things that have been on your list that you've said, oh, I'm going to eventually go do that thing. I need to do that thing. Just go do the thing, right? Just take the action now. Do not wait. Do not procrastinate. That will help you have the most fun year of your life, de-stress. And so those are just some of the insights from the Ultra Wealthy Investor Club Family Office Club event. I hope you enjoyed that and got some insight. That being said, I do have some guests with us today, some strategic alliances, some potential clients, and people looking at the deferred sales trust. So we are going to touch on that. And I want to invite a few people into the conversation. We have Rebecca, Micah, and Jake. We'll start with Micah today. Micah, how we doing? Happy Friday to you.
Hey, how we doing? When you were kind of going through that list, I was mentally thinking, well, how does this play into the deferred sales trust, right? And the truth of it is it really does. Because as you're trying to downscale or simplify or bring others that are closer to you, it totally makes sense to do it with the deferred sales trust as well. Because maybe you're stuck in some properties or one property that sucks up a lot of your time. and you're wanting to spend more time with your family, or you want to go ahead and do a different venture, like that is the freedom that the deferred sales trust will allow you to do and get out of that same 1031 cycle and really help you in what your goals are.
Yeah,
So,
absolutely. We call that part of the 10 freedoms, right? Those 10 freedoms of time, location, really stress. Like, what is those time, energy, vampires, right? It could be that property, it could be that business, it could be that state in which you reside that's very restrictive to do business. I mean, whatever that is, like clarifying what that is, and then just cut it out. And oftentimes what stops me from just cutting out is they go, well, the tax, right? I can't afford it, or I don't want to, just, pay 30, 40, 50% of my proceeds to the government and tax. And that's where the DST comes in for that bridge to gap. Jake Carpenter, do you want to add to that? And what do you think about that, Jake?
Yeah, we've talked in the past about how you choose your team. And that goes into what you were saying about surrounding yourself with people that put into you, that can lift you up. And that's what I like about the team. When you take the deferred sales trust on, and by what I mean by that is you choose your team in implementing the deferred sales trust. We're not in the box thinkers. We're all out of the box thinkers. We share the same principles that you were just reviewing, Brett. We're going to the same, you and I just went to Family Office Club event. We're in the same circles. We've got the same goals. We are focused on how to maximize freedom, maximize time, focusing on family, focusing on identifying what's important and how to bring those things to the surface. And just like Micah just said, the deferred sales trust may not be the be all end all, but it is one of the key strategies that can be, as Jake Miller says, the keystone to the planning and all the other things that you're doing in your retirement plan, estate plan, income planning, tax planning. I call it, managing tax flow to maximize cash flow. Those important things that resonate with you, with your family, with your faith, with your freedoms, all those things have to do with what we can do on the deferred sales trust side in putting a positive team around you to make the most of what you want to accomplish, help you identify what those things are and get there.
Absolutely. I love the way you said that, maximizing, tax flow yeah. So basically marrying tax flow and cash flow, right? To make sure that
managing tax flow
to maximize cash flow. Exactly. And then sometimes it's also to maximize tax flow on the back end, because you might even manage the cash flow to be lower in certain states, and we go to a new state, which ultimately goes back into managing cash flow because you have less tax there, or managing tax flow to eliminate estate tax altogether, which ultimately creates opportunities for more wealth. And so there's all of these little parts of, let's say, if you're peeling the onion back on the DST. And in fact, last week we talked about how to make the DST an investment and not an expense. You can go back to my YouTube channel and check that out. Go to Capital Gains Tax Solutions YouTube channel, and we break down how to make the DST an investment, not an expense. And these are all the ways to do that as you understand how to manage the tax flow to maximize the cash flow. So, Rebecca, what do you think? Anything that sticks out to you when I talk about the insights for the ultra wealthy investor club, family office club, and the de-risking the average, or anything that kind of resonate with you, Rebecca?
So what really resonated with me was definitely looking at my notes, more about the law of proximity and who you are spending time with, making sure that you're leveling up and you're spending time with the people that are going to bring more wealth to you, bring more happiness, having that balance. Because you did talk about, good deals, bad deals, people that are time draining, so there's that. Who are those 5 people, and making sure that they aren't the, drainers of your time, drainers of your energy. But, because there can be, one person who's amazing, like you were talking about the top producer, but maybe not the culturally balanced person. So making sure that you've got those great people, and the team with the Deferred Sales Trust should be part of that. I think we all
that
have
actually
that.
sparked another idea that they talked about. In fact, on the stage was a gentleman named Joe Williams, and Joe is the co-founder of Keller Williams, and he's a billionaire. And he talked about how if it's a great deal with, you know, either average people or people that aren't going to be great to work with, you know, high energy, high integrity, and, you know, not creating a lot of stress, and he's not going to want to do the deal. So he much rather have great people with an average deal, right, than a great deal with average people, right? So it is absolutely essential that the proximity to who you're spending time with, how you're building your character, your personal development, your leadership, all of these things matter, and they matter so much, especially if you're going to serve at the highest level. Because at a certain point with wealth, of course, it is about creating the wealth, preserving the wealth, but it's about creating meaningful relationships and making an impact with the wealth. And people want to do that with people that they know, like, and trust. So that's so key. They also talked about one other thing too is health, like ultra healthy equals ultra wealthy, right? And so often we're spending so much time on building our wealth, but we're not spending on time on building our health and our happiness, right? And sometimes we think they're separate, like, oh, I got to work harder, I got to do these things. And he did a survey, and he said, how many of you he spent, you know, less than $1,000? Oh, how many of you invested more than $1,000 into your wealth plan, right? Into your investments? Everyone raised their hand. And then he went up to like 50,000 and $1 million, and he kept, you know, and he had this survey here, right? And he goes, okay, now let's do it for the health. How many of you invested, you know, X amount for your health? And he goes, every year, it's so surprising. And the stats, they came up there, even in some of the biggest, wealthiest room in the world, right? Everyone who was in there, people are spending so much more on building their wealth plan. And he basically said, what is health? What is wealth without health? In fact, there was another quote that I saw here that was really powerful that I'll share, that I really appreciate them talking about, because it wasn't just about you know, building wealth, but it was basically here. Let me see if I can find it. Okay. Each person has 1,000 dreams, is what it says, until the day they or their loved ones lose their health, and then they have only one, right? So here's the quote here. I don't know if it can focus and come in here. Let's see if it does. Maybe not. But the point was, each person has 1,000 dreams. We have all these dreams, all these ambitions, all these things, and we're running until the day either themselves or someone they love lose their health. Then everything just comes back to that one thing. How do we get that person or yourself healthy again? And so he goes, he's imploring people, and there's this graph that shows you know, health. And basically at 28 is the average age where our health starts to go, instead of progressing, it starts to flatten line and start to decrease, right? All the science behind that. And he talked about ways to, the folks up there were talking about, here's the graph. And again, I don't know if you're able to see it. I got to get a way to share my screen, but there's this graph here. And that the opportunity for us, in fact, the most of our healthcare costs come between 65 and 90 years old. 48% of all healthcare costs come after 65. It's $2.24 trillion. And you only have 50% of your health span left. And not only that, but during that health span, those years when you're having to spend are perhaps not your most enjoyable years, because now you're having to play catch up. And it's like the law of compounding interest as it pertains to your health. And the graph basically goes like this. If you're just, you know, the average, you're doing thing average, it really starts to fall off, versus investing into your health, you get to extend when it starts to drop off. And so those quality of those years. And so the opportunity today is the most valuable investment you'll ever make. And he calls it Med 3.0. It's health, it's nutrition, it's, you know, blood test to get, you know, your exact nutrients that you're missing. And it's this ongoing investment into that health that helps us. And so I thought, oh, that was great. In fact, I remember texting my wife, Melanie, and going, hey, let's see if we can get this new app that can track certain things. We can get our blood taken, and we can get certain things to just invest into our health, because we don't want to take that for granted. And we want to have ultra healthy lives. And that'll actually in turn help us to have more energy, and to actually increase our wealth, but sometimes we're separating the two. Any thoughts on that, Rebecca?
Oh my gosh, you just hit it, exactly you're on point exactly. I mean, there's a reason why I live where I live. Part of it is lifestyle, but also, being able to live a joyful life where you're working on, your health, quality of life, and hopefully building wealth in a business or, in a way that makes you happy. So, yeah, I love it. Yeah, I'm a few years older than you are. So the idea of living, a year, basically the happiest year of your life I love that. I'm going to add it to my list this for 2024.
Absolutely. And every single year you should be leveling up to try to do that. And by the way, if you want to learn more, you can go to brettswartz.com or capitalgainstaxsolutions.com about exit planning and ways to level up your leadership. We also have the podcast and the book, Building a Capital Gains Tax Exit Plan. Pass it back to Micah. Micah, by the way, we're missing the Jake Miller today. Hopefully he's coming in.
He is catching a flight right now, so he is unavailable.
Cool. All good. All good. Any deal stories or anything that just come up recently that you think we should touch on or that maybe we can toss up for someone here today?
Well, I did want to talk on a little bit on the stressors. I mean, sometimes it's that stress that you're putting yourself under. I mean, you guys were talking about health and wellness and things like that, but we've had some people and some clients that say, I want to enjoy this next year, and not have to worry and stress about what's coming up, and kind of put the pause button on life as they know it in the realm of stress. And so the deferred sales trust can facilitate that so that they can say, you know what, I don't need to make the income right now. I could kind of turn on this other income stream and kind of plug and play and do as I want to. And that's a really unique opportunity that you may not be able to. I mean, you're putting your asset to work because, I mean, if you can't go to the store and pay for groceries with a house that you have or some property, I mean, that's a lot of power that it helps you with that I like.
In that sense, it's like, because some assets are not producing cash flow. In fact, I was talking with a client today. He has a lot of land and he's done a couple DSTs. And he's thinking about doing the land deal, and because he's not making a ton of income on the land, but more than that, he didn't have any depreciation on the land. And he also has an apartment complex that's fully depreciated. And so we're talking about, in fact, next week, we're going to talk about this concept of reverse depreciation with the deferred sales trust, kind of a teaser. Come back and learn next week, reverse depreciation with the deferred sales trust. And for him, it's like, oh, wait, you're right. I've got cash flow. I've got wealth. I've got a lot of things here, but I'm missing out on the depreciation side. How do I do that? Oh, well, there's a cool way to do that with the DST for any asset that you're selling, to reset the depreciation schedule, which is really powerful. And so sometimes it's just that, like, what can I sell to unlock the thing that would give me that freedom, give me that flexibility, give me that margin. I know for Warren and Catherine Strand, part of the 10 freedoms that they loved was the fact that they could trade their toilets, trash, and termites for more time and energy with their two twin daughters who were 10 years old. They had kids a little bit later in life. And that was an easy trade-off. Not only that, but they had an extra $60,000, $70,000 of income on the trust. So you go from $120,000 NOI to about 190, and they're like, wow, no more toilets, trash, termites, more time with the family, way less stress of having to deal with driving through traffic in California and go back and forth to the property. Why wouldn't I do this? Like, there's just so many green checkbox. But I think too often a lot of folks we're creatures of habit, and we're so caught in either the 1031 swap until you drop, right? And it just takes that one deal to do it differently. And all of a sudden, and by the way, Warren and Catherine, it took a while. Like it wasn't like a one call, tell them about it, let's go. I mean, it was a process, but they dove in, they got educated. They were intentional about, making a difference and setting a goal to be out of that property. And I can tell you, they've never been happier with having that property sold. right? He goes, Brett, it's like a weight off my shoulders. It's like just my stress is so much lower. And sometimes we don't know what the stress we're in until we're on the other side of not being in that stress. And so it's also those freedoms that perhaps you're not even thinking about or knowing about emotionally, physically, time and energy, until you're on the other side of it. And you look back and go, oh, wow, the DST really unlocked that. That's really cool. The team, Capital Gains Tax Solutions, and the investments that we've been able to make with the trust. Wow, that's an amazing thing. And I think the same is true for Jake Carpenter, one of his clients that he brought to the Deferred Sales Trust with the mobile home parks. Jake, you want to touch on that again on some of those freedoms for Gary?
Yeah, this is that's what you just spoke of. I call the 3-dimensional planning that the team, when you hire the Deferred Sales Trust team, it's the reason behind why we turn the Deferred Sales Trust into an asset instead of a liability. That the 3-dimensional strategies that you can bring, where someone doesn't realize that they have the ability to unlock depreciation schedules, even though everything that they have so far has been ran out. And for Gary, he sold 5 mobile home parks for quite a substantial amount. And the exciting thing for him is he was able to double his cash flow by just selling the parks and cashing in on the appreciated value on that, which was basically paper value, until he was able to cash in on it and create, the time and the flexibility in his life. And for him, he's a young guy, but he was sitting back going, Brett, Jake, you're telling me I can take the next 5 to 10 years, hit pause, go hunt, go fish, spend time doing what I want to do, and then I can dive back in and be actively doing more deals, creating more depreciation schedules that I can take advantage of. But for now, I can get rid of the trash, toilets, tenants, liability, termites. I can double my cash flow. I mean, my question, if you're watching this video right now, is what doesn't that do for you? Because if you can answer that question, let me know what else is out there. But Brett and I and the rest of the team on here, our job is to help you hone in on what it is that you really want to accomplish, what you want, where you want to get to, where you're at, where you want to get to, how to get there. But if you can wave your magic wand and get there with the Deferred Sales Trust, what doesn't that do for you? And why not move forward? Don't let your professionals, your CPA, your real estate broker, your attorney, your financial planner, don't let them hold you back from doing your due diligence and moving forward on educating yourself.
Very well said, Jake. I love that. And by the way, you can learn more about Jake Carpenter by going to carpentercapitalllc.com. That's carpentercapitalllc.com. He's in the state of Washington, and he's great about not only wealth advising, but also kind of wealth advising with real estate and traditional securities investments. So he's one of a kind, Jake. Thank you for sharing that. It also reminds me of what another question that was about the Family Office Club. They asked this question: what is 10 years of my life of vibrant health worth to me? And in this scenario with Gary, it would be, what is 5 years of my life of vibrant health worth to me, right? And in the context of doing due diligence, what is 5 hours of your life to determine if the Deferred Sales Trust is legal? If the fees make sense, how to make a DST investment on expense, what are the controls, and who you're working with the trustee. That's our company, Capital Gains Tax Solutions. And having your CPA tax attorney, or whoever it is that may be the skeptic or the person who has never done it before, and they're cautious and concerned, as they should be because they've never done it before, to come in and have a great discussion. By the way, we work on a no cost, no obligation basis with all of the due diligence, and we will work with you and your team to help you understand everything with NDAs and engagement agreements signed. That is what we love to do, and we want to be a part of that due diligence process with you on that journey. But it is proprietary, it is protected. But the good news is also it's close to 30-year track record and thousands of closes and over 24 no change IRS audits, never had a single change. So we're batting 1,000 so far, and it works every time if you have a team that know how to execute the business plan. Yeah, that's
so Brett, I do want to kind of hit on those no change audits because of a lot of different strategies that we kind of help clients with. The deferred sales trust is one of only 2 that has a perfect track record. And it's not that it's not being looked at by the IRS. We like that it's being looked at, but getting the track record and the history of the no change, there has been no change to it. And why is that? It's because of having it under a little bit more of a closer lock and key by the trustee, by the law firm that actually instigates it, right? And that's why we really try to work with the best in the business, because if we're working with the best, then we're not going to pollute or water down the strategy itself. We're keeping it as pure and refined as we can.
Yeah, it's great. Well said. And we call it the most vetted tax strategy your CPA has never heard of. And with that, explaining what the no change, no findings audit really means is actually it's remarkable. In fact, if any of us listening or here had a tax return audit on our business tax returns or our personal audits, they're going to find something. You're going to find a receipt that's out of place or the numbers mismatched or something where it was just a little bit off and we're going to maybe owe a little bit of tax. Maybe sometimes we'll get a refund, but there's going to be a change one way or the other. There's something, but on all of the audits and all for over 27 years, there's not been one single finding or change. And so it's like Barry Bonds getting to the plate and hitting grand slams. I think he had over 70 home runs. Mark McGwire, it's like if he got to the plate every time, he had 24 at bats, and every time he just hit like a grand slam. Like it's not just a home run in that, oh, you passed. It's like you passed perfectly for 27 years. And so for those who are cautious and skeptical, you just know that track record is perfect. It reminds me when I had my ACL surgeries for both of my knees. I played basketball in college, and I walked into the doctor's office, and the first doctor said, "Oh, you don't need ACL surgery." And he just did like the test. He was a generalist. He's my family practitioner, very smart at what he did, but he wasn't a specialist. You don't need that ACL surgery. You're good to go. He did the knee test. If you can see me, he grabbed my knee and he kind of did this thing where he lifts it up and he kind of just feels it. And I said, "Yeah, doctor, that seems a little bit too vague for me. Can we get an MRI?" You don't need an MRI. You're good to go. Don't worry about it. It's going to waste your time and your energy, and it's really expensive. And I said, "Okay, doctor, that sounds pretty good." And I went home that day, and my brother gave me some good wisdom. He said, "Go back to that doctor and tell him you require an MRI just in case, because if you come back in 6 weeks, like he was telling me, and you blow your knee the second time, you're probably, never be able to play collegiate basketball ever again." And so I went back that second time and I said, "Doctor, please, I know you're probably really good at what you do. You're a specialty in sports medicine." I said, "But just in case, let's get an MRI." We got the MRI, and sure enough, he calls me 2 weeks later. He tells me I'm wasting my time as he's writing. I'll never forget his supreme confidence that I was wasting my time, that my knee was fine. He's signing the referral and he hands it to me. 2 weeks go by and he calls me and he doesn't say anything except for, "The results are in. Your ACL is completely ruptured. You need reconstruction surgery." And I went from wanting to believe that I was totally okay to be back for the season to completely devastated. But because I listened and I got the second opinion and actually got the real evidence, and that's the key here, right? What I'm getting at, it's not just the opinion of the professional, it's the actual evidence, right, of the MRI that was the convincing part for him and I. And that's oftentimes what we see with CPAs. In fact, it's the most vetted strategy your CPA has never heard of. Part of it because they've never actually done the MRI. They've only ever done maybe a general search on the deferred sales trust. They find a blog here, they find something here, and they haven't done the MRI. What's the MRI? You jump on a call with us, you sign an NDA, you look at the trust documents, you talk with the tax attorney. We explain in detail what it is, what it's not, how it works, how you report it, because most CPAs just want to know, how do I properly report it on the tax forms? And we tell you exactly what tax form to use and how to report it. Guess what? Here's a secret. It's the exact same form that if someone just did an installment sale on. It's not a different form. It's not a secret form. It's the exact same form. We fully report on the same form that you would have reported if you did a regular installment sale. And that's how simple this is. And then CPAs go, oh, got it. I've seen the MRI. I've seen the evidence. I know how to report it now. And all of a sudden they join us. Happens repeatedly. And so we want to encourage you to take action and don't let the CPA do a drive-by 60 miles an hour and not jump on that call. Now, also pay the person, pay them. Say, I want to pay you per hour to try to poke holes in this. Let's go through this together. Keep an open mind. All that being said, we do need to set this up prior to the close of escrow. We need to set this up prior to the buyer removing all contingencies. Unless you're in a 1031 exchange and you've worked with us prior to that, then we have the best 1031 exit plan. You can go to experttaxsecrets.com for that, where we can have an alternative and save your failing 1031 exchange in case it fails. But it takes action. It takes getting with us early so that you have options. I want to pass it back to Jake Carpenter. Jake, any thoughts on that?
Yeah, I do want to jump in and just say, ladies and gentlemen, if you're watching this right now and your CPA, your attorneys say they have never heard of this before, it does not mean that they are not a really good CPA or an attorney. It just means that they don't do brain surgery in this area. They're a general practice type of professional. It's not an ill reflection on them, because I've had a lot of folks that I've been working with say how good their CPA is, and that if they were so good, how come they haven't heard of it? Most general practice professionals could be the top in their field, but they don't know how to do or evaluate brain surgery. And that's the reason why this surgeon that has a perfect track record, this strategy that has a perfect track record, we bring in our own surgical team to work with your professional and educate them. But the most important thing about this is you must demand that your professionals go through the due diligence process to educate themselves, because Brett and I both know, and probably Jake Miller as well as the rest of the people on this call, if you don't insist that they go through the due diligence process, they're making a very, very expensive decision for you that I would not be comfortable with my CPA or attorney making for me. And I'll give it back to you, Brett.
Yeah, very well said. That's Jake Carpenter, everybody. And so, yeah, we invite you in. And by the way, 97% of the time, 98, if you bring them in early and you talk with us and you bring them along for the journey versus being in the rearview mirror, have them in the driver's seat and or the passenger seat as you guys are coming on the journey, they say yes, right? But we're always looking for just one more who didn't say yes. And we look at that and we always want to help that one more. And as a part of that, that means we've looked at how those ones have not happened. And it's typically because A, the CPA either wasn't open to it, B, the client did not pay them to do due diligence. C, they brought it to them last minute and they try to do the due diligence on their own and then present it to the CPA. And so this is not a time to cut expense, it's a time to invest in for your future, which means investing for them. The last part of it is sometimes the CPA just says no. And guess what? Sometimes the person to help you from 0 to $1 million or $1 million to 10 million, it's not the same CPA tax attorney to take you from 10 to 20 or 30 to 50 or 100 million and above. Sometimes you have to level up your team, and sometimes that means changing the team, right? Changing the team. And so we're here to support you on all of this, but ideally working with the CPA collectively together. Also, the last point I make on this is your CPA sometimes think they're the ones that have to defend this. They don't. In fact, the CPA tax attorney who represents you, our business partner, they're the ones who defend you and should the IRS come knocking. And no additional charge. There's IRS audit defense. And that's important to understand. And when CPAs hear that as well, they go, oh, okay. And sometimes when the client doesn't necessarily present it in that way, they just say, come look at this. Let me know if it works, instead of, look, it's already worked. They will defend me. Would you come alongside to ask any questions I might be missing? And let's make sure we report it properly on my personal tax return. When you say it like that, also their guard tends to go down, and they're like, oh, okay, that's great. They're adding to the team. They're not replacing me, A, and B, they're not asking me to defend something I've never done before, right? So it's those little nuances where if you can just get them to the call, we promise we'll do a great job of educating everyone everyone on your team. Yeah, if you want to take action, go to capitalgainstaxsolutions.com.
So Brett,
yes, go ahead.
I think it would be a good idea to kind of highlight the client's position here, where they are the owner of an asset, and when they move forward with the deferred sales trust, they become a note holder of that same asset. And kind of the power and the strength that happens is them as the note holder, right? I mean, we've all had mortgages, and if we default on our loan, who gets the house? It's that note holder or our mortgage company, right? So if you could kind of expand on that a little more for our audience, that'd be great.
Yeah, we're talking about building a capital gains tax exit plan. And as a part of that, you want to understand the roles, right? So there's the third party unrelated trustee. There's a financial advisor like Jake Carpenter or Jake Miller, who works with Micah Miller. And there's the tax attorney, CPA firm that we talked about that does the audit defense and starts to help you with, help all of us to build the trust. But what you're doing is you're trading your asset that you own. Let's just say it's a $10 million worth of Bitcoin, or a $10 million business, or primary home, or stock. That is the asset at first that you own. And instead of holding on to that asset or selling it and paying directly tax, if you sell it directly to the market, you're actually going to sell it to the trust in what's called an installment agreement, meaning you're going to carry back 100% financing typically, right? So at that $10 million sale, you're receiving a promissory note for $10 million, but the actual cash doesn't hit your personal account. And that's the deferral of the tax until you receive payment. It's not unlike a 1031 exchange or an IRA in that sense, that instead of having it personal for your personal use, you're foregoing that for a period of time until you receive cash flow or payments from that. Do you pay the tax? And so what's happening, and Mike is referring to, is you're becoming a note holder. You're taking your ownership hat off of the asset, the real estate, the business, the stock, the crypto, in exchange for a lender to the trust. So the trust receives the cash, okay, from the ultimate buyer. The trust bought and sold for the same price, so there's no gain at the trust level, and you receive the promissory note. So you do not own the trust. If you own the trust, it'd be taxable. You are the note holder. You are the creditor. You are like the bank. You're the bank that lent the money. And so you have all the rights and protections of a lender, which means what? You can foreclose on the trust or foreclose on the collateral for this trust to have to pay you back, right? And that's the key. And then it pays you back, and then you pay your tax. And so, by the way, we haven't had to have that. That hasn't happened yet, right? We've been able to get the returns. The returns are somewhere between 6 and about 9% compounding net of fees, generally speaking, over any 10-year term. And so we've been able to do that, but it's not a guarantee. We got to go invest the funds. These are all these things that are involved here with your risk tolerance, your cash flow needs, your wealth and impact goals, and how we can weave this into your legacy. And so that's a key distinction, Micah. Anything you want me to add to that, Micah, or subtract, or what are you thinking there?
Yeah, I mean, you touched on different asset classes, and that is a really big part too on the deferred sales trust, because rather than just doing a 1031 exchange from one like-kind property to another like-kind property, we're able to really diversify and kind of expand in your portfolio so that you can liquidate crypto. You can use a racehorse. You have a lot of opportunities. It could be the sale of your business. And a lot of times, I like that it can be diversified into all the different types of assets that are available. I mean, there's people that say, I've been in real estate, I've done real estate, been there, done that. I need something else to diversify. And this is a great way to do it.
Yeah,
or even to wait for that next opportunity, whether it's the same asset or whether it's another business or something else completely.
Yep, we have the timing on our side. Rebecca, by the way, what to people in case they're wondering, what's a good size that we found? Like what's some of the minimums in case someone's wondering, should I use this for $100,000 deal or should we really do it for $1 million or greater?
Yeah, so great question. So on the bare minimum, you want $1 million of gains, $1 million net, $1 million gain. If it's going to be a primary home, then you want at least $1.5 million, ideally $2 million in, gains, net gains. Yeah. So.
Yep. Well said. So $1 million net proceeds, $1 million gain per transaction, unless you have 2 at 500 each. Unless it's a primary home, then we typically want about $2 million of gain because you have that 121 exclusion. So really what we're saying is these have to be larger deals. And the reason is it has to be enough tax paying, right? Tax paying, somewhere between 25 and 50% of the gain is going to be taxed depending on the state you live in and the depreciation recapture. And so you got to make sure you have a big enough tax liability. So step one, what is your adjusted basis? What is your sales price? What is the debt? Get those 3 things there. That's very important to help to clarify where you stand and what tax problem you have. Go to your CPA, determine that number, which means if I sell for $5 million, I have a $2 million tax bill. Okay, great. So we've got the $2 million we're trying to solve for. Now we can go to work to say, all right, based upon having 5 million versus let's say 3 million, what would that mean for you long-term with the cash flow and the ability to build wealth, pass it to your kids? Now we're really working this in a way that's going to be an investment and not an expense versus, hey, I've got a $300,000 asset and I have a $100,000 basis. I have a $200,000 gain. This can be too small with the fees, the ongoing fees, and just the overall pain of that. It's too small. Now, if you had a $5 million estate and you had a $2 million asset you're going to sell in a year or two, and you have a big gain there and you want to start out with a $500,000 transaction, we can accommodate that because now you can consolidate and bring these things together. But if it's just that single asset, that single sale, it's not a great fit on the minimums. That being said, we're basically up the top of the hour. So I want to encourage everyone to take action right now. If you want to find me, you can go to capitalgainstaxsolutions.com. But Rebecca, people want to get in touch with you. By the way, Rebecca is an amazing luxury realtor in Tahoe and the Truckee area. She helps people buy and sell real estate there. Rebecca, how can they find you if they want to find you?
Sure. So RebeccaMunson.com, and that's MONSON. And 530-448-9740. Working on an 800 number, but yep.
That's cool. Thank you, Rebecca. And Jake Carpenter, if people want to find you, where they can find you.
Best way is call at 509-396-5292.
Fantastic. And Micah Miller, if people want to find you, where they can find you, and you and Jake Miller.
Absolutely. Go ahead and jump on strategictaxsolutions.com and book an appointment there.
Fantastic. I want to thank everybody for listening today. I hope you got some wisdom from the wisdom that I received. Hope I passed some of that on to you for the insights from the ultra wealthy, #1 ultra wealthy investor club in the world that we know of, Family Office Club event. I hope you're going to spend some time thinking about how to be ultra healthy and ultra wealthy, and also how to level up everything that we're talking about with the DST. Take some action today. You can go to brettswartz.com to learn about all the stuff we're doing on YouTube. We're doing with our best 1031 exit planning and a little bit more about me and Capital Gains Tax Solutions. We appreciate everyone out there, and we'll talk